Hello, everyone, and welcome to another episode of The Long and Short of It. I'm Patrick Ceresna.
And I'm Nick Galarnik.
All right, listen, Nick, I love getting together with you every second week to do this. Lots of really interesting things going on in the markets. First off, yesterday was the inauguration, Trump coming into office. Lots of interesting, but one of the interesting observations is we've been going through a bit of a market correction through the month of December into the first few days of January. And the pullback is much deeper in small caps and in equal weight indices. And really things like the Mag 7s held up. Now what we see is a little bit of a different setup. Like here, I'll just quickly show on the chart. Interesting thing, like today, a day where, for instance, you have the NASDAQ and the S&P up considerably. You have the Mag 7s actually flat on the day, and they've really not participated. Stocks like Apple and Tesla and other stocks like this just simply have started to shit the bed while the rest of the market is ripping. And so we've seen this rotation, and the rotation really has been that the incredibly oversold small caps and let's say the equal weight S&P 500 suddenly make a comeback. The breadth of the market widened, financials started to work again, a whole series of these sectors started to turn, and it's been a lot of this market getting some buzz. What are your thoughts? You think that this was just a correction and there's a bull continuation happening in the market? The volatility's been contracting. What are your thoughts on the bigger markets here?
Yeah, I think we see some upside perhaps in the short term. I initially thought that we'd see some perhaps downside into the March OPEX, and that's still possible. I mean, we're not at all-time highs yet on SPX, and on the small caps right now, Russell, we're still very far away from the year high of near 245, which is actually a key point that I noted in looking at some data around inaugurations. So the trade that I want to talk about today, Patrick, is IWM call spreads for the February OPEX, namely the 235, 245 bull call spreads. Current spot price is 229 roughly. And some data points to look at for inaugurations over the last few inaugurations. For one, the Russell's been green every single time 20 days out following inauguration back to 81. The last three inaugurations, it's been up 6.2%, 2%, and 7.9% respectively. Overall, it's been very, very strong performer. So right now, off that bottom of 215 or so, we're already up to almost 230 roughly. And I think it could push toward that all-time high mark, the recent high mark of 245, which would allow this trade to become max profit. So right now, the current debit cost of this trade is about 215. I actually got into it last week at 130, so it's already up about 50% for me. But nevertheless, it's still offering 4-to-1 reward to risk right now, which is still great asymmetry of risk. Now, using my same rules of risk management, if it were to pull back, for example, down to, let's say, $1, I would exit for a loss if I got in at this current entry price. However, I do think that we can see a strong push toward 240 at minimum, at which point I would then de-risk my position by selling half of it on a double up and then riding for free, essentially.
Okay, so let's talk about on the chart just to kind of explain a little further. So we obviously had that pretty significant market correction. What's interesting about this entire pullback, it spent about a month trading below the 50-day moving average, and it was about a 61.8 retracement of the August to November rally. And so it was a much needed market correction, but it met all the criteria of just a correction, not a crash or a bear market. And so after a correction, asymmetry resets. That's when you have an opportunity where the upside potential is there because the correction is rear view. We are now seeing literally the first closing candle above the 50-day moving average, which is a very good arbiter of trend because when an indice starts trending, it tends to stay above the 50-day moving average throughout the entire trend period. It's It's interesting that we're getting that first close above. Obviously, there's no certainties in the markets. This market bounce has been now retraced about 50% of the prior decline. It is a little bit of a kind of inflection point on it, but often, even if this was a bigger topping formation, it is quite common for things like double top formations to occur. So the fact that you're looking for the first only month to potentially rally, and you're really setting targets with the spread for simply retesting the previous highs, makes it a really interesting trade to me. Like I think that that if this is going to follow through, throughout the remainder of January into early February, then that is a logical place to be targeting on the upside. So let's take a look at the spread now. First of all, you specifically were targeting the February expiration. So I have here the February 21st expiration. So we're talking about a trade that literally has a month. Today we're recording on January 21st. So we're talking 1 month of time on this February trade, going to the main monthly OPEX on this. And for a $10 wide spread, you're talking outlaying just over $2. At least for someone entering this trade. So that is, you've got 4 times the upside potential of your capital outlay, which is the type of risk reward that common swing traders look for when setting up a trade like this.
Yeah, that's right. I mean, when you look at this overall trade setup and look at the data points, let's assume that this follows through and we get some kind of mean action around the data points of post-inauguration. So 20 days out is the reason why I chose this expiration, is because it factors in about 31 days until expiration overall. So we capture that period of time in which the data points are telling us that after an inauguration, small caps rally pretty heavily. And given the asymmetry of risk, if we were to, for example, take a loss and it were to pull back down to, let's say, like 220 again, drop about 9 points, a stop loss would hit at about $1 or so, taking a 50% loss on the position. So basically, you're really risking $1 to make a maximum upside of roughly $8 or so, right? If you were to factor in a total loss, you're risking $2 and change to make a maximum profit of $8 or so. And that would occur if IWM expired above 245 on February 21st. Now, obviously, a break-even point is your first strike price of 235 plus the debit cost of $2 and change, so about 237 roughly. And then you want to de-risk your position, obviously, because again, remember that your asymmetry of risk is dynamic. It's not going to be static where it's the same at all times. If, for example, it goes to $4 tomorrow, I don't want to be risking 4 to make 6. That's not a great asymmetry risk. However, given that my entry price was much, much lower, I'm okay taking some off and then de-risking, because if the trade goes south, not a big deal. I've already banked some profit, kind of like we did it with the Google trade a few weeks ago, right? So,
well, I agree with you. Like, I just to add to that, like, now again, there's different ways of approaching trading, and obviously a long-term position trader is not going to make as active decisions. But when you choose to play the trading game based upon statistics and odds and payoff profiles, then you have to dynamically adjust as the payoff profile is adjusting. Is exactly what you're suggesting. I hope I'm correctly
That's correct. That's
describing your thing.
Yeah.
And so a situation where if you outlaid $2 and your trade doubled, let's say you had 10 contracts. Now you may want to ratio it differently, but let's just keep it in a super simple format. Yeah. If your spread went from $2 to $4 value and you're up 100%, when you sell 5 out of the 10 contracts and you took all your initial principal out of the trade, then actually your cost base goes pretty much to zero on the trade on the remaining 5 contracts. Now your payoff profile dynamically changes, because now you're only risking profits, not risking initial principal. And therefore you can allow that trade to actually develop more and give him more wiggle room to be wrong on the short term, to see it through for a potential big win. There's a lot more dynamics in there. So what is your thought process though? Like, what is the trigger point? Is it the dollar amount that you're up, or is it a level on the IWM that you're looking for? Where's your, how do you determine your decision point for making that adjustment?
So for me, it would be based on asymmetry of risk, but also factoring in expiration as well, right? Let's say we're about 2 weeks until expiration and my position's trading roughly flat. I don't want to let it bleed out into expiration and go to, 1 and then 0 perhaps. So if I still have a strong thesis around that trade, but yeah, keep in mind, this thesis exists based on data points that I've collected over the past, roughly 45 years back to 81. Right? Which tells us that post-inaugurations, small cap should run heavily. So if, for example, it doesn't happen in the next 20 days, taking us to somewhere around like February 10th-ish, that would be a telltale sign for me to say, you know what? My data points didn't align with the current trend. I'm going to exit the trade because I no longer have a valid thesis anymore. But also, if, for example, we pop, let's say to 235, 240 on IWM, and my position goes from 2 to 4 to 5 or so, I'm going to de-risk because I'm thinking about the amount of money I have at risk at that point in time. And I don't want to be risking 5 to make 5 because at that point you're risking 1 to make 1. I want to take some off, like you said, and pretty much allow the trade to go to fruition with pure profits trading. And as it goes toward expiration, I might de-risk a bit more because I don't want to let that profit go to 0 as well, right? So let's say it goes to 5, I cut half, for example, and then we're approaching expiration, it's going to 4 or 3. At that point, I'll say, you know what? I'm going to take the rest of my profit off the table and then find the next trade, essentially.
So I want to actually illustrate by example, like on my screen here. I used a close enough simulation of where the IWM is. So you can see I have the Feb 235 by 245. And here it's about a $2 debit. It's basically 250 gains 50 cents, rounding obviously, or basically a $2,000 outlay. What I wanted to just illustrate the point that you just made, and I wanted to just show it there, is that let's say I time decay the trade with all things being equal, where it's now 2 weeks before its expiration, right? It's 14 days before. At this moment, you're down about $800 on this trade. But what's interesting is that a lot of the loss has been offset by the gains from the out of the money position.
That's
but
right.
now, to the point that you're making, there's only 9 cents left on this 245 call. You're basically theta burning at this point that entire remaining call option cost, like like a long call, like if you're long gamma outright, like literally the offsetting option doesn't have any time value left to continue to remain as an offset. And so to your point, like when you, even if let's say this was closer to your break even, where let's say the stock was trading at like the IWM was at 233 and this entire trade was flat, right? And still in a situation where there's only now 23 cents of time value left on that out of the money call, it basically is the offsetting theta is actually really small. And this is where if the trade doesn't work in your favor right away, you can watch that spread just implode. Like it's where if it goes against you, you have to accept a potential drawdown that's greater than, let's say, 50% stop loss, right? Like if let's say the IWM dropped rapidly to 225, you'd find yourself, with the option being worth 34 cents just like that overnight.
Yeah,
and that's the crazy part of holding into the final weeks.
And that's why you also want to use a stop loss on most positions, especially shorter term positions, because again, if you take these small trades where you're risking between 1% and 5% of your account, and this is for traders, not investors. I'm saying this for, and let's say you risk, for example, like 1% of your account on this kind of trade, and your stop loss is 50% loss. You're going to lose 0.5% on the trade overall. But if you make maximum profit, you're netting out at 4x of 1%. You're netting out at 4% return on your overall account, risking 1%. Now, obviously, if you're de-risking that one transpired to be a maximum of 4%. It'll be somewhere between 2 and 3% perhaps. But the whole point is that you have to be consistent with your decision making in managing your risk, because it's a long time horizon you're looking at. You're not looking at each individual trade as like a one-off. You want to look at your overall actions across, months and years, right? And if you're following the same, it's kind of like playing poker, right? If you're betting sporadically based upon your probability in your hand, you're going to probably lose the game. But if you're betting consistently and saying, you know what, I'm going to wait for a good hand to arise. When it does, I'm going to bet accordingly, and I'm going to pretty much play the hand out. Either I'll win or lose based on probability, but I'm going to keep on playing the same way the entire time, right? How do you think the best poker players in the world win? They win because they follow strategies and they follow them long term. They don't just try one strategy and then lose and then go to an next strategy, right? In a similar vein, most traders jump from one thing to the next, very, very often. And as a result, they never really see the fruition of their labor overall, nor do they actually learn from their mistakes, because you can't learn from your mistakes if you're pivoting your strategy every 5 minutes, right?
Right. No, I completely agree. All right. Well, listen, thanks for sharing. It'll be really interesting to see whether this trend follows the same thing that's been going on for many decades in the past. So
I agree.
Good luck to your position there. And maybe in 2 weeks, we'll get a good update from you as to where that's trading. Speaking of updates, me and you both talked about two trades in the last couple episodes. I talked about Boeing and you talked about AMD. So let's put up first a chart of AMD. Now, clearly it has remained in a downtrend. It was a challenging period in the market, and it simply never turned up there. What's the update on the trade and how you ended up trading it out?
So the update is that the stop loss hit last week when we hit the lows. So it was a 50% loss on the position overall, about 265 from the 530 entry point. I am still bullish on AMD, and I do hold them longer term in the form of leaps as well as some stock as well. So I am still bullish, but again, part of the game is taking losses, and unfortunately that happened. The funny thing is I went back and looked at my data from last year. So out of 97 trades that were of the same duration roughly, 15 of them were losses, 1.5. And of those trades, 12 of them ended up being very, very profitable. So I might kick myself if we watch this run heavily, because they have earnings next week. And obviously, if they have a decent report, they might spike heavily. And I'll say, you know what, I should. But the point I'm trying to make here is that it doesn't matter if you were right in hindsight, because you need to follow that pattern of decision making. If you don't follow that pattern and stick to your guns, you're never going to be consistent at all, right? So taking the loss is part of my strategy. I said, you know what, either stop loss or profit, and it happened first. So what? That's what happens. And if it props to 150 in a few weeks, so be it. I'll be happy on my long-term positions. I won't be so happy on this position, but that's what happens.
Well, listen, let's talk quickly about Boeing, because that was a longer-term position I had. But I think it's a great segue to talking about earnings, because Boeing has its earnings coming out on Tuesday the 28th, so we're basically a week away from its earnings, and it's we're going to find out whether an earnings hand grenade pin gets pulled or not. Like there's a element of where, as much as I love technical analysis and anchor off of it, ultimately earnings is a catalyst point that doesn't care what the technical setup was before the earnings. When the news comes out, whatever the news drives, then potentially new trend moves. And so obviously there's a risk point to Boeing here on the short term. But I wanted to just talk about the trend of implied volatilities going into an earnings. So let's use Boeing as an example, since this is an interesting one to kind of dig deeper on. And so when I pull up here the volatility lab in Interactive Brokers, we can actually see that volatility has been contracting, but we're not showing the weekly here. This is only the monthlies. And so this is the February, March, and April. And what's interesting is right now going into an earnings, anyone actually positioning in longer term options, 1, 2, 3 months, 5 months out, are actually getting volatility levels on the options that are actually at the bottom end of its 2-month range. And so it's not actually expensive to express a position through options on a longer term position on Boeing. But what you can see is that if I come in here and add, I want to actually focus here on
Earning
two
date.
options. Well, the one before and the one after. And so
Right
what I
after.
want to highlight is that the the option that expires this Friday had almost an outright implosion. We're down to like the other day it was down at 28%. Yeah, 27, 28%. But look at that option that overlaps the earnings, the Jan 31st one. And this thing has exploded up to 43%. And of course it is. It's going to command a volatility premium because the implied ranges of an earnings reaction have to account for a wider range of outcomes. And so the implied volatility has to be more expensive. But I think the one thing I want to just take away from this, of course, you're going to end up paying a larger volatility premium if you're taking an options bet directly on the short dated options that expire directly associated with the earnings. But the fact that Boeing is actually very reasonably priced on its implieds 1, 2, 3 months out means there's plenty of opportunity to still put on Boeing trades here that are in the larger time horizon and the bigger and playing the bigger game on that. Now the earnings is going to be a mover there. It would be obviously disappointing. Let me put up the chart again here, but it would be obviously disappointing if we had an earnings disappoint the way, let's say, it did back in August. So you can observe here when it disappointed here, it had a very rapid kind of $20 drop on the downside. That would obviously, be disappointing because that would almost certainly usher in a close below the 50-day moving average and potentially, something that could retest its previous lows and put Boeing into a purgatory for the first half of the year, pushing out the story into later in the year type of a scenario. And this is why the earnings is going to be so important. Right now, the chart looks very bullish, but, earnings could definitely derail that. And if you're in a long dated leap position, and you're really worried about the earnings doing a surprise, just the exact example of what you did with IWM with calls, you could always just put a bear put spread hedge on your long dated leap, right? Like at this moment, you go out to the very reasonably priced FEBs from an implied perspective, and you turn around, put in some sort of a debit spread hedge that will kind of blunt a disappointing downside surprise.
Yeah.
And then you can confidently hold into the earnings in the hope that the turnaround story is really gaining steam. And then, you can really play with some upside traction. Any thoughts on that?
Yeah, I mean, like one fun thing that I like doing when I'm playing, longer dated options with like leaps, for example, if I'm trying to hedge, is if you're in a margin account, you can sell, for example, poor man's covered calls for a few months out, capture that premium, and then buy a shorter dated put option for very, very cheap. Because again, like you're playing. So in this case, like you mentioned, the January 31st volatility is very, very high because it factors in Boeing's earnings for next week. So you don't want to be playing that exact same week because you're paying a lot of premium for that 1 week. So buying a few weeks out, like, February 21st OPEX instead makes a lot more sense. In this case, as you said, with the put spread to hedge, you could buy the 165, 155 put spread right now for about $1.60. So you're risking 160 to make, 840, which is pretty phenomenal asymmetry of risk. And the implied move right now for next Friday is 10 points. Just for reference on how implied volatility works, the implied move for this coming Friday is only about 4.5 points. And the implied move for February OPEX, which is about a month away, is only about 14 points. So you can see the kind of the changing implied volatility pricing, from $4 this week, which is only, 4.5 days away, to next week is $10 on the earning event itself. To a month out, it's only $14. You're paying $4 more to capture essentially 3 more weeks, right? So you never really want to be buying options on that expiration date that aligns with the same week as the earning event. Also, why I chose the Russell today to discuss is my idea, because I'm very bullish on Google, for example, right now, but they have earnings as well in this time period, and buying, a call spread, for example, is very, very risky because it's binary. They could have a great report and drop, right? They can have a bad report and pop. It's a very, very binary outcome, and you want to try to avoid those outcomes overall, right? So with Boeing, yeah, you could definitely hedge if you want to short term by selling some premium out of the money, maybe for like March OPEX, for example, using that to buy some short term puts. That might make sense. Or you just buy a put spread if you want to hedge, or you have your thesis intact and you say, you know what, I'm confident I'm buying more than a year of time because I believe that by that time frame, my trade will be profitable by X amount, for example.
Absolutely. All right. Well, listen, Nick, I think that does it for a wrap for today, but I think great idea. Let's find out how the small caps trade out and whether they can stay above that 50-day moving average. It's going to be an interesting couple of weeks. We'll be back in early February for the next episode. Otherwise, thank you all for joining us. Now, Nick, before we let you go, where can members and listeners, find you and follow your stuff?
So my website is optionfinity.com. That's optionfinity.com. And also on Discord as well. I have a small group there as well.
Awesome.
Link is below in the video too. And awesome. I just want to say, you guys, always manage your risk, okay? Always manage your risk.
There you go. Good advice. All right. And you can follow me at bigpicturetrading.com. Thanks, everybody, and have a great day.
Thanks, guys. Take care.